So why don't we start off with FOMC? What was the key takeaways from FOMC and from what Powell said?
So obviously going into FOMC, right? Like the big question was, and we talked about this last week, that being how is the Fed going to guide forward, right? Everyone's wondering, we're restrictive. What is the next step, and when can we start talking about rate cuts, which is pretty much what the soft landing and stage three predicated around.
All right.
Right.
So basically, the soft landing, for that to really come to fruition, the Fed needs to basically thread the needle and start bringing in rate cuts while the economy is slowing as well, and kind of really balance things out, which we say is
Right.
a pretty low probability of actually pulling off.
Right. So, something to note, right? Powell did say that they're restrictive. They believe that they're restrictive enough. We've been saying that for months now. The Fed is, in fact, is very restrictive. In matter of fact, and there may be even too restrictive at this point in time. And what I want to elaborate with that by saying is, even the Fed is now starting to say that they're seeing a possibility we could avert a recession. And so far we have, but the results are not guaranteed. So basically, what you're seeing out of the Fed is them capitulating into stage three. They are now in the camp of basically saying that they believe a soft landing is happening. As they say, they're not in. There was no evidence that we're currently in a recession, so they are insinuating that we are in fact in progression of the soft landing. So I think that's important to note because remember, for the soft landing to really materialize, you need the Fed, right, to basically cut interest rates in a way where as growth slows or comes down, right, and the economy starts to wind down a little bit, those interest rate cuts offset that slowdown and almost balance the economy instead of crashing. Maybe even a shallow dip, and we continue on upwards. That's really what the soft landing is. There's no real recession. There's no unemployment spike. There's no major crash in interest rates. It's just a gradual liftoff and continuation. And I think that the Fed does believe this is the most probable outcome at the moment, or the outcome with the highest probability at the moment, right? And even Powell has to go out there and say certain things that basically hedge himself, right? One of those things was saying that if they see above trend growth, it could ultimately mean that they're going to hike interest rates even further. Believe that or not, right? So like they have to get in front of both ends of the stick and make sure that they're guiding the market into thinking that there is a high probability of a soft landing, while also saying if things actually start moving the other way, we're going to continually hike. And I think that's very important because right now in stage three, which is the third stage of the four-stage compound landing, stage three. So in stage three, we hit the peak this week. Pretty much, it's been in the making for some time. We've been at the peak. We've been building up to it, but we are past the peak now. So now we are going to ride the back half of stage three down, and ultimately, if things line up, into stage four. And what that basically means is, or excuse me, what does that basically mean for the stock market, right? That's probably everyone's question. And I think that the best way to sum that up is to emphasize that you were in an environment where stocks and bonds both went down, and we're most likely going to see some reversion. We have been seeing, and we will continue to see some reversion of that. And that's just because if you're not going to have a recession, stocks bid up. Simple, right? And if you're not going to have a recession and the Fed is going to ultimately ease policy and cut interest rates at some point down the road, bond yields will put in bonds will put in a bottom, yields will put in a peak, and they'll start to trend slowly and gradually lower, and therefore bonds go up, equities go up. Now, this doesn't happen for a very long time. Eventually, the idea is that if the Fed were to achieve a soft landing, yields would stabilize, and bonds would pretty much chop and do nothing while equities continue higher.
So the question
Stage
is going to be what's going to be the outperformer, right? Is do you want to be
right,
allocating money to stocks or do you want to be allocating money to bonds? Because likely both will be going up from here.
right. And the question that you have to be asking yourself is the validity of stage three, right? Stage three, is stage three going to culminate into stage four? And based on if you were to just to listen to the Fed's presser this week, you would think, or and Powell's speech, you would think maybe stage four isn't going to happen, right? Maybe stage three is it. Then we go back to a booming economy. And that's the bet you make when you buy stocks today, right? You're betting that there will be no consequential growth slowdown and no correlated inflation slowdown in the process that would bring you into this semi-deflationary environment where growth is negative. Maybe it's not as negative as people are expecting, but inflation is below trend, below target, right? Below 2%. If you think we can avoid that environment, then bonds probably won't be the best performer. But again, if you were to listen to the Fed, you'd think that's the most probable outcome. Meanwhile, the Fed is sitting here telling you, right, that they are going to need to reduce rates before they get to target. And we spoke about this last week, right? You can't wait till inflation gets down to 2%, then start cutting rates. You're going to be too far behind the curve. And they're also aware of that they're running the risks of basically staying too high for too long. That's the essence of stage three. That's what sends us to stage four. The Fed overstays their welcome. So Powell admitted that they're going to need to reduce rates and that he is aware of the risks of being too restrictive for too long. So he's basically aware of stage three being the ultimate domino bringing us into stage four. The problem is he's also pretty adamant about stating that there's no reason for any QT adjustments and that the reserves remain ample, meaning there's no question at the moment of stopping QT. And if we look at the SOFR conditions, the conditions of the short-term funding market, that is right. He is right when he says that. The short-term funding market has very little stress at the moment. So what Powell's basically saying, right, in a very condensed format, the short-term funding market's okay. There's no reason to adjust QT. Inflation's going down. It's not a target, but we're likely going to have to adjust inflation, our interest rate policy along the inflationary path of recovery. This way, we don't stay too tight for too long. And then, simply put, there's a good chance that the Fed is going to cut interest rates at some point in the future while running QT. So we're going to finally see that dynamic. Which, honestly, if you would have asked anyone this question a year and a half, 2 or 3 years ago, they would have told you it's ridiculous. But we're starting to see higher and higher odds of a Fed running QT while cutting interest rates, which would
What
be
kind
quite
of
interesting.
environment do you think that's going to breed? Is that going to
Well,
be both a stock and bond positive environment?
obviously, this is where the second factor of this whole idea of stage three and four, right? So remember stage three being the pivot to stage four, where we get to stage four, and that's the recession or slowdown. If it's shallow, if it's deep, it doesn't really matter. It's just it's the slowdown, right? And in the slowdown, bonds would outperform equities. The bet here that people are pricing in peak soft landing is that bonds won't significantly outperform stocks, which is why people are going to dive into stocks. Because the idea is that the Fed will not have to drastically cut interest rates because there will be no severe or substantial slowdown. So, with that said, what you have to pay attention to is the fact that if the Fed is running QT, so they're removing reserves from the system, right? This is the second variable. The first variable of this whole dilemma of stage three is the Fed, and practically what fuels stage three is the Fed staying too high for too long, right? So that we're talking, that's only too restrictive for too long. That's an interest rate perspective. You now have to add in a QT or a balance sheet perspective into this. if the balance sheet is material in financial conditions, in the scope of markets, if the balance sheet is material and it really makes a difference, not only now do you have a variable of the Fed having to thread the needle on interest rates, you now have them having to thread the needle as well on balance sheet reductions, because the Fed has been very clear. They made it very clear this week that they're not going to question QT at the moment. The reserves are ample. They're going to let QT continue, while they did at the same time talk about interest rate cuts. So the Fed is almost moving where they should be with rate cuts. In my opinion, I think we spoke about this last week. The Fed should have reduced rates at least 25 basis points today or this week. They should have done one rate cut, or at least signaled that there's a high probability that they will reduce in the coming meetings. Like they should have adjusted the dot plot to show that there would be at least one rate cut between now and the next meeting, between the next two meetings. They should have indicated that, because they are playing this game where they're trying to manipulate financial conditions with verbiage. But they still have to, at the end of the day, they have to act, right? That's the problem. So if they want to show the market that they're not going to over tighten, then they should have to emphasize to the market that bringing interest rates down, maybe only gradually, 25 basis points every other meeting, something along the lines of that, would be a start at trying to straighten out this big jumble soup that we got going on here between running QT and cutting interest rates at the same time. One is a tightener and one's an easer, so they're basically trying to offset each other. Now, I think this goes back to what we were also saying last week. Will the markets find out that maybe QT QE is useless? Maybe the impacts of reducing interest rates significantly outweigh the impacts of QT. And I think that's something we're going to have to really just wait and find out, because if that's the case, then we are basically going to be made, basically through seeing in real time, we're going to find out that this whole QE QT nonsense in the balance sheet world, pretty much most of it was nonsense.
Yeah, that would be really interesting to watch, because that's going to be a first in a lifetime event, right? That's never happened before.
Yeah, especially with the way the size and just directional easing and tightening that's been done over the last, mostly easing, 3-4 years. Now you're going to try and reverse it, or gradually reverse that balance sheet while cutting interest rates. It's going to be interesting. What happens in the process? Well, as I said earlier, you're adding a second layer of conditions that have to be met. So you're basically adding another leg to your parlay here for the soft landing, right? The Fed's going to start reducing the balance sheet. Now the question is, well, what happens if they let QT run on too long? By the time they realize that they've gone too far, are you going to have a backup of prior Fed rate hikes that are being basically restrictive policy moves that are bleeding into the market, which they still continue to today? And as you start reducing rates, you're basically offsetting some of that. You're delay the rate as the rates come down. You have a delay, right? So think of it like there's a lag in the policy that's seeping in from the rate hikes, and there's going to be a lag as from policy being removed from the market with rate cuts. So it's kind of like a jumble soup there. But then on top of it, the second layer here, the second leg, is you have the Fed running QT. So if the Fed just messes up with QT, and let's just say QT is in fact a material driver of the stock market and the economy in terms of liquidity and what and so on and so forth, then you now have the Fed having to land both of these perfectly. So it's very interesting, as they say, they put themselves in a position where they're going to run one against the other. And I think that if the Fed does run QT too aggressive or for too long, they're going to have to flip to the old not QE cycle, where they're going to start pumping up the balance sheet, right? And that would likely be continued with further rate cuts. The problem is how do you judge how much to do and what is too much or what's not enough? All in the cycle of trying to bring inflation down to target gradually, firmly, but not too fast to the point where you overshoot it. I think this is a very complicated problem. It's not something that one person or even a small group of people can figure out efficiently, especially given that, again, they're meeting less than 10 times a year. in terms of actually they have to make less than 10 decisions a year, right? So it's less than one decision a month on such a complex problem. You have to come from a base assumption that they will actually mess this up. There's a possibility that they don't, and we've said this since day one. There's a possibility that you can get a soft landing. It's very slim.
Yeah, but it feels like the market is actually it's mispricing that probability, especially
Well,
the movements that we've seen over the last couple of weeks. The market
see,
seems to be too. I don't know. This is the way that I'm seeing it. I'm wondering how you're seeing it, but it seems like the market is kind of pricing in a very high probability of the Fed pulling this off, higher than what actually is the real probability.
of course, and that's how markets work, right? So markets price in things, and it's our job as participants to look at the market and say, okay, this is making sense. This is not making sense. And the models help us do that. They help us put everything together into a singular output so we can look at things from a bird's eye view at the market and the models and compare and contrast and basically make our case. So I think that given the current situation, the market's pricing in, like you said, the peak soft landing, right? So the market's going to run up equities while gradually running up bonds, because remember, in the soft landing, rates don't need to come down very fast. Growth is resilient. Boom, there's your equation. Stocks up, bonds up, but not as much. The problem with that is you need to see this continuation. Number one, the Fed is over. There's going to be a point here where if the Fed doesn't start moving interest rates lower, they're going to actually have missed their window for the soft landing, be overly restrictive for way too long, and running QT, sucking reserves out of the market, eventually negatively affecting the short-term funding market and overall market liquidity. So I think that you need to look at it from that perspective. Right now, the market's up. Stocks are up, as they should be in stage 3, right? If they're bullish trend within stage 3, stocks should go higher. What should happen? So the problem is how the question you have to ask is, and you have to observe, more so observe, right? How fast do things shift from stage 3 to stage 4? For example, are they a 2018 thing, right? Let's talk about 2018, where everything seems to be good, and all of a sudden, boom, something hits the fan, right? And obviously, this was due to the rate hikes at the time being the market really being surprised that Powell's going to lift rates further to fight an inflation problem that may have not been so much of a real issue. Powell just wanted to get ahead of the curve, and the market got very scared. Now the question is what happens if the Fed stays too restrictive for too long? And by the time the Fed realizes they've overstayed their welcome, the market will have already priced that in. This is the dynamic between stage 3 and stage 4, which is why it's very interesting. Could we, and this goes back to the soft landing, like if the Fed were to start moving interest rates lower and monitoring the balance sheet runoff and staying on top of things, could they nail both of these perfectly and pull up the soft landing? And the answer is it's always a possibility, but I wouldn't make that my base case because, again, you're talking about a lagging institution that's referencing lagging data. By the time they come to realize what is going on, likely the damage is already done. As I said earlier, we should be reducing interest rates gradually, or at least laying the framework. And I think Powell tried to do that at this meeting, but he again was standing on this hawkish position of above trend growth. We need more hikes. We're restrictive enough, but we're not at a desirable level of inflation just yet, and we're going to have to reduce policy before we get there. We can't just let inflation go to target and then start reducing. So he's basically saying that he wants to cut, but he can't cut yet. He hopes to do it soon, type of thing. And I think that the Fed could have pulled off at least one rate cut. I think that would have been something that would have sent both. It would have What it would have done actually was fueled stage 3 even more, to be honest. You would have gotten people that were really expecting the soft landing, and it would have fueled at a higher degree, and stocks would have been up a lot more.
Is that what they would want, though?
Well, the question is how, like, hear me out. If the Fed did one interest rate cut, we would be pricing in way more than 100 basis points of rate cuts because the market would get ahead of itself, right? And I think that maybe Powell is trying to lay this up to the point where like he's insinuating now so he can do one maybe later. But the problem with this all lies in the second he does one rate cut, everyone's going to expect, okay, we are now in a cutting cycle. Right? And I think Powell's going to try and hold out for as long as he can, because once you start going down like that, even one rate cut, and you start insinuating to the market that things are going to get easier in terms of financial conditions, or I should say interest rates, then they tend to amplify off of that. So Powell's afraid that inflation's going to go up, right? He's afraid that if we start reducing rates right now, maybe we're going to spike another inflationary run. And I think that you have to play both. You can't ignore the fact that if you want a soft landing, you have to cut interest rates at a time where you could essentially respark inflation, right? You can't get the soft landing by waiting to cut interest rates until you're certain inflation will not run up again.
Which, how could they be certain?
They can't. You have to take that risk, which is what I was insinuating earlier with the Fed cutting interest rates. They could have gotten away with a cut right now. Yeah, the market might have been up a lot more, right? And maybe bonds would have been up a lot more. But at the same time, if the Fed's voicing it properly, I think the market would have gotten ahead of itself. And at the next meeting, they could have brought it back into correction, right? They could have they could have recentered everything.
Yeah.
But I think the Fed wants to make a statement here. Remember, they have a statement to make. Inflation in 2022 was not the president's problem. It was the Fed's problem. Powell was under a lot of pressure with this whole inflation problem, testifying, basically being marked as the man that couldn't control inflation. Eventually now he's got it under control, but it was all on Powell, right? Powell was inflation. He was being mocked for saying inflation was transitory, and then it wasn't, right? So he can't let inflation go back up. So his biggest fear is inflation going back up. That's literally it, right? He doesn't care about the market going down 20%.
So he's going to play the safe card.
No right, and this is the problem. How do you get the soft landing playing the safe card? I don't know. I don't know the answer to that, but I can tell you that you obviously, it's like it's like going against the wind when you're trying to sail, right? Like if the wind's telling you to go this way, you're trying to go the other way, your boat's not going to move. And I feel like that's what Powell's being given the opportunity to bring interest rates lower gradually and somewhat pull off a soft landing. But the academia side of that's the logical side of this. The academia side of this says that it's going to be very hard for them to cut interest rates with unemployment at record lows and inflation not at target. So what happens in this scenario? What happens if the Fed has to say, well, we're going to reduce interest rates, but we want to wait until there's more stress in the labor market? He said this week the labor market's coming back into a balance, but it's still it's coming back into better balance. So it's still out of balance, but it's improving. So again, this goes back to the Fed making a move right now in their books based on their structure is seen as an early move, which is why they didn't. And maybe they will in March, but I don't know. I don't know if Powell's got it in him to just come out with an interest rate cut in March. And the question is as we price up cuts going into these FOMC meetings, right? We're pricing in over 100 basis points of rate cuts by the end of the year. If we start going into these meetings and the Fed is not pricing in rate cuts, what's going to happen is this whole soft landing idea, stage 3, is going to start getting unwound. And that will mean that some of these equity gains may be at risk from now until we get more clarification on how the Fed's going to proceed from here. And this is all of what stage 3 is about, right? This is exactly what it is, what stage 3 is in terms of everybody expecting the most improbable and safest exit to a hiking cycle. Meanwhile, we have a lot of things progressing under the surface that people don't want to acknowledge, right? Commodities are not up. If we take a look at DBC, right? There's people are like, oh, commodities up after FOMC. That was this move right here. Oh, inflation's gonna rip. Like, be real. Come on. Where's the pressure here? I don't see it. I really don't see it. Commodities are literally mean, if we take our measuring stick here, we can find we're pretty much almost 5% off 52-week lows. There's no damage here. There's no inflation damage here, right? So the fact that people or the Fed is concerned still about inflation's resurgence makes me think that they are scarred from that 1980s era where they cut interest rates too aggressively, too quickly. And I think they're going to have a problem. We're going to have a problem bringing rates down. And I think that's the key. That's that domino that falls over and brings you from the back half of stage 3 into stage 4. And ultimately, the thing we're going to be watching are long bonds, because this is a stage 3 move in bonds, a back half soft landing move in bonds.
That's like the first indicator of nearing stage 4.
Right. As this progresses and we flip the bullish trend and we start stabilizing and then ramping up from there, that's not going to be stage 3 anymore, right? Because if you think about it, the market's priced in over 100 basis points of cuts throughout 2024. The bond market knows this. That's what this is, right? That's what the market's pricing in. But this is only the soft landing. If you're going to get a hard landing, it's not going to be 100 basis points of cuts. We're not going to be at 4%, right? Because if you think of the Fed's target being 2% inflation, if we get a hard landing, stage 4, the Fed's going to be under inflation target, right? So we need another 200 basis points on top of that.
So the odds of bonds being the outperformer going forward seem higher than equities.
Yeah. Well, that's what the system's telling us to a degree, right? To a degree, the system's pointing in that direction. But ultimately, we have to look at it from a macro perspective too, that the Fed is running QT and they still haven't cut interest rates. We're only now talking about rate cuts. The Fed is not a fast mover unless there's an emergency. So we'll have to see when that first rate cut actually comes. But the Fed's still in a very restrictive state and running QT. So those two factors alone are working against equities because they're adding further pressure to the economy, aka affecting growth to a degree, therefore supporting bonds to a degree. Simply put, as long as the Fed is being restrictive and I should say overly restrictive and without a timely descent that's being illustrated, the odds favor bonds. But we're not going to long bearish trends in bonds. And we have to respect the fact that until that shift happens in stage 3 to the back half of stage 3, until the back half of stage 3 expires and we're in stage 4, equities can go higher. But like I said earlier, the question is, do equities drop 10% in a week? For whatever reason, that's the risk that you play when you're long equities in the back half of stage 3. You have to be okay with all of a sudden this type of price action here, right? Like where we're sitting up here in October, early October, by the end of October, we were down 7%. Maybe I said 10% in a week. That was a little aggressive, but you get my point. This was basically two weeks. The market went down almost 10%.
Yeah, right? Just based on the environment that we're going to be in, it's kind of a breeding ground for equities to have those kind of sharp drops as growth gets affected. We basically have the inflation side of things under control. It's the growth side that it's basically what will determine the trajectory of equities and bonds. So if growth really does collapse in an actual hard landing stage 4 scenario, bonds are going to do great. Equities are not going to do great. And that's kind of seems to be like the most probable outcome
at the moment, right? But and that's going to be an outcome in stage 4, right? That's the stage 4 outcome. So I think for us to get to that outcome, where we may have to endure some higher equity prices along that way, right? So think of it like a roadmap where we've just hit stage 3. We're in the middle. We just passed the middle of stage 3, and stage 4 is coming. At this point in time, we're on the path. The only question is, how many winds, twists, and turns are there going to be between the back half of stage 3 and stage 4?
Yeah, and
By
stage
getting
three
this
can last longer than even we expect.
right. And we said this from the beginning. If for whatever reason there's a risk on pivot, that means the system is actually picking up a more resilient market than even we think. So you have to be open and aware that if the market dips and there's a risk on pivot, vice versa, right? Um, take advantage of it if that's the case. At the moment, that isn't the case, but it very well could be the case if stage three wants to play the long game. What I mean by that is, could we be in the back half? Stage two and stage three happened kind of quickly within 6 months, 6 to 7 months. But what about the back half of stage three to stage four? Maybe that back half of stage three is also 6 to 7 months, right? That could be a scenario, and we have to be ready to take advantage of that if the triggers are there. But I think that's where we can wrap up the podcast this week. If you guys have any questions, feel free to reach out to us on Twitter at the Market Radar or on our website at market-radar.com.